Hey everyone, welcome back to Corporate Decoder, the place where we crack open the complex world of corporate finance and reveal what it all really means. Today we are diving into a massive SEC filing from Franklin Custodian Funds. This report covers a whole bunch of their different investment funds from tech-heavy to utilities and even income funds. We will break down some of the key financial performance numbers and see what story they tell. Before we start, if you appreciate getting straightforward insights from all these corporate documents, make sure you are subscribed and hit that notification bell. We also have a Discord community linked in the description if you want to dive deeper into discussions. Alright, so Franklin Custodian Funds is filing its annual shareholder report for the period ending the 30th of September 2025. Think of this as a yearly checkup on how these investment funds are doing. Let's jump straight into the Franklin Dynatech Fund class of shares. For the year ending the 30th of September 2025, the net asset value started at $165.87 and ended up at $208.38. That's a pretty nice jump up. The total return for this class was 25.63%. This is a strong performance, especially when you compare it to the S&P 500 index, which returned 17.60% for the same period. The fund mentions its performance was boosted by favorable stock selection in the industrial and energy sectors. It also benefited a lot from information technology stocks, which made up over half the fund's assets. Some standout performers that really helped were Axon Enterprise Kratos Defense and Security Solutions, and even Taiwan Semiconductor Manufacturing. Now, while performance was good, let's talk about costs. For this entire report for Franklin Custodian Funds, the total management fee paid was a hefty $107,660,802. For the Dynatech Fund Class A, that means on a hypothetical $10,000 investment, you paid about $87 in costs. That is 0.77% of your investment going towards fees and expenses. It is important to note that this percentage reflects fee waivers and reimbursements, without which the expenses would have been higher. Next up, we have the Franklin Growth Fund class of shares. This fund returned 12.53% for the year ending the 30th of September 2025. That is a solid return, but it trailed both the S&P 500 index, which was up 17.60%, and the Russell 1000 Growth Index, which was up 25.53%. The report highlights Amphenol and T-Connectivity as top contributors in the information technology sector, which is understandable given the boom in AI infrastructure. Amphenol, for instance, benefited from strong demand in its data center business driven by AI spending. On the flip side, Danaher and Mettler Toledo International were detractors in the healthcare sector due to macroeconomic headwinds and specific challenges in China and diagnostics. It looks like the fund was underweight in Broadcom, a chipmaker that saw significant gains. The cost for a $10,000 investment here was around $82 or 0.77%. Shifting gears a bit, let's look at the Franklin Income Fund class of shares. This fund returned 6.43% for the year ending the 30th of September 2025. This is a much more modest return compared to the growth funds, but it is important to remember its investment objective is different. It compares its performance to a blended benchmark, which returned 5.60%, so it did outperform its benchmark. The report mentions top contributors included the healthcare and industrial sectors along with securitized products. On the equity side, Boeing, Fannie Mae, and Johnson & Johnson added value. However, US Treasuries weakened returns for the fixed income portion, and the materials sector also detracted due to losses from Ardac Holdings. The costs here were $72 or 0.70% on a $10,000 investment. The fund also mentions a significant change in its investment strategy effective the 1st of February 2025, which revised its principal investment strategies to better reflect that the equity portion consists of convertible securities and equity-linked notes in addition to common stock. They also reduced the limit on below investment grade debt securities. Now for the Franklin US Government Securities Fund class of shares, performance here was 2.42% for the year ending the 30th of September 2025. This is much lower than the growth funds and also underperformed the Bloomberg US Government Intermediate Index, which returned 3.51%. The report points to exposure to Ginnie Mae the Suican coupons as top contributors and Ginnie Mae the Suican with lower coupons as detractors. This is typical for bond funds where coupon rates directly impact returns and interest rate changes can cause fluctuations. The costs for this fund were $86 or 0.85% on $10,000. Finally, we have the Franklin Utilities Fund class, of shares returning 13.99% for the year. This fund outperformed the S&P 500 Utilities Index, which was up 11.20%, but lagged the broader S&P 500 index at 17.60%. Top contributors were in the electric utilities industry, especially Entergy Corporation, which benefited from accelerated growth and supportive regulatory wins. Vistra also delivered standout performance fueled by rising power prices and anticipation of favorable power sales agreements. On the downside, Edison International and PGID shares declined due to concerns about wildfire liability, which is a recurring theme for utility companies in California. The costs here were $86 or 0.80% on $10,000. The total net assets across all these funds is a staggering $29,449,022,573. That is a massive amount of money being managed. The portfolio turnover rate for the Dynatech fund was 29.61%, indicating a moderate level of trading within the portfolio. Now, looking at the broader picture and the Warren Buffett style analysis here is my take. The Franklin Dynatech and growth funds showed strong performance driven by tech and favorable stock selection, outperforming benchmarks in many cases. This signals a good understanding by the managers of current market trends in growth sectors. The Franklin Income and US Government Securities funds, however, showed more modest returns and, in some cases, underperformed their benchmarks. This is not necessarily a bad thing for income or government bond-focused funds, where stability and income generation are prioritized over high growth. The Utilities Fund performed well relative to its specific industry benchmark, demonstrating strength in that particular sector despite lagging the overall market. A notable weakness across all funds is the existence of various share classes with different expense ratios. For instance, the Class C shares consistently have higher costs than Class A or R6 shares. While this is standard practice in mutual fund structures, it means investors need to be mindful of which share class they choose to maximize their returns. The significant management fees, though tiered and potentially reduced with scale, are a considerable factor in overall returns. An interesting opportunity for these funds, particularly the income and utilities funds, could lie in leveraging the current economic climate where some sectors might be underperforming, while others are showing resilience. However, the risks mentioned, such as macroeconomic headwinds and geopolitical concerns, are always present. For the tech-focused funds, the race for AI dominance is clearly a major driver and opportunity, but also a potential risk if market sentiment shifts or certain companies fail to deliver. Overall, Franklin Custodian funds, through these reports, showcases a diverse range of strategies, each with its own performance narrative. While some funds excel in growth, others focus on stability and income, showing a broad spectrum of investment approaches. It is crucial for investors to understand the specific objectives and risk profiles of each fund before investing. Alright, that is our breakdown of these Franklin Templeton filings. What is your take on these numbers and what they signal for these funds and the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps the channel, and subscribe for more straightforward corporate breakdowns. Don't forget to check out our Discord linked in the description below for more discussions. Thanks for watching. See you next time.